let's turn our attention now to the market reaction, because we did see a big sell-off yesterday, a bounce back today with the biggest gains on the NASDAQ. Lamar Villere is portfolio manager of Villere Co. And Lamar, yes, we're seeing a bounce back today, but I guess the question here is how much of the sell-off we saw yesterday is the start of a larger pullback that we could see regardless of the outcome of the Senate race?
Well, I don't think there's going to be a massive pullback either way. I mean, I think we will see a downturn if Republicans don't hold on to the Senate. With that said, the Fed's not going anywhere. The Fed is keeping rates low. That's going to keep investors in stocks. So even if you do have the concerns of increased taxes, the concerns of an increased regulatory environment, you're still going to have low interest rates. And, people like us and our clients are going to have to invest their money somewhere. And if you're getting 1% from a treasury, that's not going to get it done. So people are going to need to put their money in stocks, and that's how investors are going to have to look at it.
Yeah, Lamar, I guess the question becomes which ones seem like the right risk-reward ratio there when you look at opportunities on the table here, depending on which way the Senate could go. I assume there's some that would work regardless of how those races turn out. So when you look at those opportunities, which ones are catching your eyes as the best on the table right now?
Sure. So we've been looking at a company and buying some shares of a company called Palomar, which is an insurance company. About 2/3 of their business is earthquake insurance, which gets pretty complex. But the thing you need to know is they're able to underwrite these plans, we think, in a more thoughtful manner than their competitors. They're growing very quickly. Even if there's a 1906 San Francisco earthquake, and the bulk of their earthquake business is in California, even if there's a 1906 type earthquake, they're still going to lose a maximum of $5 million. So it's not as risky as it might sound to investors. So really, here you've got something that has nothing to do with the outcome of the election, nothing to do with what's going to happen with COVID and et cetera. So there are ways to play it. Another one that we like right now is on semiconductor. That's a bet basically on cars having increased technology and the 5G rollout. If you've watched TV, if you've watched any bowl games or any NFL games or any other sports, you've seen a ton of ads for the 5G networks of the different carriers. We don't know whether Verizon, AT&T, or T-Mobile is going to be the winner in the space, but we do know they're going to continue a huge amount of investment there. On semi goes into every one of those boxes, so there's a huge rollout to come. So there are still ways you can participate in the market and still find growth without overly worrying about what's going to happen in the Georgia Senate race.
Among some of your key concerns when you look at the market, Lamar, I'm looking at S&P concentration, a big concern for you. You say it's a systemic risk. What specifically do you see that worries you?
That's exactly right. So, essentially, the market indices were created as a general measure of the market, and they're very different in how they're calculated. And I don't think investors really pay much attention to how the Dow versus the Russell versus the S&P are calculated. But what's happened in the last 10 years is a ton of investors have shifted a massive amount of money into the index funds. These indices were not created to be investment vehicles, and what's happened is you have this artificial surge in the very largest companies. So what you're seeing is especially the largest tech stocks, Facebook, Amazon, Apple, are getting massive valuations. No one's even really looking at what their valuations are. They're just pumping money into the cheap, low-cost index funds and assuming that way they're diversified. If you really pull back the sheets a little bit, they're not nearly as diversified as they think. And we think there's a risk there that it's going to be a significant bubble, and those rarely end well.
Yeah, Lamar, let me just push back a little bit on the idea that some of these fears out there might not be worth considering when we think about the Deutsche Bank fund manager survey that was pointing to the biggest fears among fund managers, and that would be risks on the COVID front when we think about maybe the vaccine distribution not going as smoothly, or the idea of variants starting to pose problems for those vaccines as well, something we've been discussing today. Those things aside from also the potential upsets in these Senate runoffs, when you put them all together, it seems like the main, take right now seems to be that Q1 could present quite a bit of problem there. Oppenheimer saying the Senate races could trigger a 6 to 10% correction. We've been discussing that for a while. So you don't see that necessarily playing out in the first half of the year.
It could. I think Well, number one is, we're longer term, so we actually would love for there to be a 5 or 10% pullback because we're sitting on 10 or 15% cash in most of our accounts. So we'd love a pullback so that we can get some money to work. The run up has made it difficult to find great values, so a pullback would be fine. We do think, I would not be surprised at all to have some issues with the COVID vaccine rollout, but I think by the time you get to late second quarter, I think the bulk of the people who are at the most risk are going to have had the vaccine. And as we saw with last year, investors are willing to look past short-term volatility. Who would have thought with the shutdown that we had, we'd wind the year up as well as we did last year. And based on the numbers, the actual productivity numbers, things look pretty scary. But I think investors are willing to look ahead and see that things look like blue skies ahead.
All right, let's just use one last of your picks here as a good debate over that point too, because you like Caesars here, and that's a stock obviously impacted by what's going on in Las Vegas, but nonetheless, the stock's up 6% ahead of where it was pre-pandemic, trading at least a 5-year high here. That's far back this chart that I'm looking at goes. Talk to me about why that might not speak to the idea of valuations being stretched here, and how you could pair that with some of the risks that we were just discussing.
Sure. So yeah, at first blush, I mean, it's actually up. It's up 6% over last year. It's over 10 times above where it was at the lows when the fears were at the absolute highest. This is not as broad a bet on casino gambling, although that is something that we do think is going to come back. It's more Caesars specifically. So we're concentrated managers, so we're not betting on all casinos to do great. We're betting on Caesars. Why? Number one, it's all U.S., so it doesn't require as much international travel as some of the more multinational casino operators. Number two, what they've found in terms of their recent marketing spend is they can get away with a lot less marketing spend than they did before, and it's not impacting demand whatsoever. So we think that's going to help it be a better margin producer. And number three, they're buying William Hill. So this is going to be one of the largest online operators. We see massive opportunity for growth there. In fact, you look at DraftKings right now is worth more than all of Caesars without any brick and mortar assets. And we think Caesars is going to be able to use the growth within online and its dominance within the U.S. markets of the casino to really put up some great margins and some fantastic growth.
You try and find a stock that shows more of a V-shaped recovery. It's hard to find one that says it more loudly than what Caesars did there since the bottom back in March. But Lamar Villere, Villere Co. portfolio manager, appreciate you coming on here to chat all that with us. Thanks. Be well.